Imagine you're sitting front row at a grand illusionist stage. The curtain rises. A man in a crisp suit smiles confidently. He holds up an annual report. "Ladies and gentlemen," he says, "watch closely." The lights dim. A company with billions in losses suddenly posts record profits. A liability vanishes. A merger makes losses look like synergy. You blink, you squint, you want to believe it's real, but deep down, you sense the trick. Welcome to the world of corporate financials, the only theater where numbers lie and illusions pass for facts. Every year, millions of investors get dazzled by these tricks. Quarterly earnings appear solid, debt seems manageable, profits rising, until they aren't. Until the stock crashes, the lawsuits begin, and the magician quietly exits stage left. You weren't watching financials, you were watching a magic show. But what if I told you? There's a way to see through it all. This is not just a lesson in accounting, it's a journey into the art of forensic vision, learning how to decode illusions crafted by some of the smartest financial illusionists in the world. CEOs, CFOs, bankers, and auditors, each playing their role, hoping you'll applaud without question. But today, you won't. Because this time, you're not the audience. You're becoming the magician's rival, the analyst who knows where to look when a number disappears, the investor who sees not what's shown, but what's missing. This video is your initiation, a front row tour behind the curtain of deception. We'll expose the sleight of hand behind goodwill, EBITDA, revenue spikes, and buried debt. We'll dissect scandals, from Enron to Nikola, and show you exactly how the illusion was built. And by the end, you won't fear the magic. You'll command it, because once you learn how the trick works, it can never fool you again. Chapter 1. The Vanishing Act of Earnings. You hear it every quarter, we beat expectations. The CEO beams on the earnings call, investors cheer, and headlines explode with joy. But what if I told you that what you're seeing isn't earnings at all? It's a carefully crafted illusion, the first act in our financial magic show. Because unlike revenue, which is fairly straightforward, earnings are a stage, set, painted, and lit by management. They're shaped by choices, assumptions, and sometimes deception. Take Informix, the once hyped software company. In the late 90s, it dazzled investors with soaring revenue and stellar earnings. Analysts fell for the show. Stock prices climbed. But behind the curtain, something dark brewed. Channel stuffing, fake sales, aggressive recognition of income that never materialized. When the truth emerged, the illusion collapsed. Informix restated its earnings downward by over 200 million. And the magician, gone, replaced, with shareholders left holding shredded tickets to a vanished dream. You see, the income statement is where illusions begin. It's not outright lies. That would be too easy to spot. It's how companies interpret accounting rules with flexibility that would make a Cirque du Soleil contortionist jealous. Depreciation schedules can stretch or compress. Inventory methods can shift from FIFO to LIFO. Reserves can be adjusted. And suddenly, earnings go from mediocre to magical. But don't blame the rules. The real problem is the performance. When executives are paid in stock options tied to EPS, when Wall Street values quarterly precision over long-term vision, the stage is set for manipulation. It's not fraud, it's not illegal, but it's the difference between real performance and performance art. And here's the thing most investors don't realize. Once you understand how malleable earnings are, you stop being hypnotized by the headline numbers. You begin asking deeper questions. What's the quality of these earnings? Are they sustainable? Are they cash-based? Or built on accounting smoke? Because in Act 1 of our magic show, the trick is simple. Make mediocre numbers look miraculous. But if you know where to look, you'll see the trapdoor before they pull the lever. You'll catch the glimmer of the mirror, the angle of the light, the sleight of hand in the footnotes. And as the lights go down and the curtain prepares to rise again, the illusions will only grow more complex. Chapter 2. The Floating Profit Illusion. Now the magician moves to the second act. He waves his wand, nods to the audience, and suddenly, profits rise, even though business hasn't improved. Revenue looks flat, costs are constant, but net income, suspiciously healthy. Welcome to the illusion of floating profit, earnings that levitate without real economic support. At the heart of this trick lies one of management's favorite tools, one-time charges. Picture this. Your company had a bad year. Sales dropped, market share crumbled, and morale's in the basement. But instead of letting those losses show up naturally over time, management bundles all the bad news into one massive write-off. They call it restructuring, or strategic repositioning, or non-recurring impairment. Sounds harmless, even hopeful. But it's really a way to clear the deck, to bury bad performance in one colossal expense, then pretend everything is clean moving forward. This was the infamous big bath technique. Companies like Sunbeam and WorldCom mastered it. They'd purge all sins in one dramatic swoop, ensuring that next quarter's results, scrubbed clean of old baggage, would appear miraculously better. But those new profits weren't real. They were simply floating above a hole where truth had been buried. Here's where it gets dangerous. Investors, hungry for turnarounds and headline miracles, often accept this illusion. They forget to ask, was this really a one-time event, or a convenient dumping ground for recurring issues? Will these same non-recurring costs show up again next year, wearing a different mask? In a world where perception can drive stock price more than performance, CEOs are under immense pressure to manufacture optimism. And the income statement, with its adjustable filters and flexible formats, becomes a stage where floating profits look like genuine success. But there's a way to deflate the illusion. Instead of just glancing at EPS, look for adjusted earnings and compare them against cash flow. Trace restructuring charges over multiple years. If one time becomes every time, you've spotted the trick. Ask, are the company's profits built on true operational excellence, or are they hovering on accounting smoke? In the magic show of finance, illusions evolve. Act 1 uses shadows. Act 2 uses levitation. But don't blink. The next illusion doesn't just hide the past. It hides value you never saw coming. Chapter 3. The EBITDA Mask. Now the magician steps closer. He says, let's simplify. Forget the noise. Let's focus on EBITDA. And the crowd nods, relieved. But here's the twist. Nothing real has been sold. No cash has changed hands. Welcome to the illusion of revenue without real sales. This trick is performed through the art of revenue recognition timing, a game of when, not if. Companies that desperately need to impress investors often reach deep into their accounting toolkits and shift revenue from tomorrow into today. The tactic is subtle, seemingly harmless, but its impact can reshape perception entirely. Consider software companies in the early 2000s. Many would sell licenses bundled with services, and then accelerate the recognition of license revenue even before installation or delivery. The illusion, future income reported as if already earned. Informix, again, was guilty. They shipped software to resellers with generous return rights, booked the revenue up front, and called it a win. But those sales were not real, just pulled forward like a rabbit from a hat. This isn't fraud, not always. The accounting standards allow for interpretation, but when incentives are high and scrutiny is low, lines blur. A contract with multiple performance obligations becomes a magic box. Recognize part now, delay the cost, defer the complexity. To the untrained eye, the financials gleam, but to the magician, it's just misdirection. Modern variants of this trick abound. Subscription services booking annual deals up front. Tech companies bundling hardware with long-term support and claiming 100% revenue on day one. Sometimes the customer hasn't even used the product, but the revenue's already booked, celebrated, and spent. So, how do you defend against this illusion? Read the revenue recognition policy buried deep in the 10K. Study contract liabilities. Look at deferred revenue trends. Ask, is revenue rising faster than cash? Are accounts receivable swelling while actual collections stall? Because the magician wants you watching the top line, clapping at the growth. But you, the truth seeker, know better. You know that not all revenue is real. Some of it is just borrowed time, dressed up in accounting makeup. And in the next act, we'll see how the magician not only manipulates time, but uses emotion to disguise one of the most dangerous games of all, the restructuring charade. Chapter 7. The Restructuring Roulette. The magician returns to the stage with a solemn face. We've made mistakes, he says, but we're turning the page. And with that, he announces a restructuring charge, a sweeping strategic realignment, jobs cut, offices closed, assets sold. The audience leans in, empathetic, even hopeful. They believe this painful step is a one-time cleanse. the beginning of something better. But behind the curtain, this isn't transformation. It's a tactic, a deliberate reshuffling of accounting cards. This is restructuring roulette, and the game is rigged in management's favor. Here's how it works. The company bundles every bad forecast, underperforming asset, and anticipated cost into one giant expense, recorded today. They call it a non-recurring charge, but what they're really doing is taking tomorrow's pain and stuffing it into today's financials to create smoother sailing ahead. Suddenly, next quarter's margins look better, earnings rebound, Wall Street cheers, but nothing operational has changed. Tyco, in the early 2000s, played this game aggressively. Every time it announced a merger or divestiture, massive restructuring charges followed. These charges helped reset expectations and inflated future earnings. Each spin of the roulette wheel masked the fact that real problems remained until the company crumbled under scrutiny. The trick lies in the language. Non-recurring implies this pain won't return, but savvy investors know better. Many companies take restructuring charges every single year. New label, same disguise. It becomes a recurring, non-recurring expense. And once you notice the pattern, it's hard to ignore. So, how do you spot it? Go back 5 years, map every restructuring charge, see how often they occur. Match them to executive compensation targets. You may find that these strategic resets conveniently align with performance goals. And when you do, the illusion falls apart. Because this isn't about cost savings, it's about expectation management. A carefully staged act to lower the bar so management can clear it and claim victory. But while this trick manipulates perception, the next act manipulates time itself, using depreciation and amortization as tools to reshape the past and rewrite the future. Chapter 8. The time warp trick of depreciation and amortization. Now the magician turns to the clock. "Let's stretch this moment," he whispers, "and compress that one." And with the flick of a pen, he begins to manipulate time, not with spells, but with depreciation schedules and amortization timelines. This is the time warp trick, a subtle illusion where companies control the passage of financial pain. Assets don't expire instantly. Buildings, machinery, software, they all wear out gradually. But how quickly that wear and tear shows up in the numbers, that's up to management. Consider this. 2 identical factories with the same equipment. One depreciates its machines over 10 years, the other over 5. On paper, the first looks more profitable. Less expense, higher earnings. But nothing changed in reality, just a slower tick of the accounting clock. That's the magic. Amortization adds another layer. Intangible assets like patents, software licenses, or even customer lists are amortized over chosen periods. Companies can argue for longer lives, spreading out the cost thinner, making the bottom line appear plumper. It's not fraud, it's flexibility. But when used strategically, it becomes a distortion. Now, imagine a company fresh off an acquisition. They've booked goodwill, customer contracts, and proprietary tech. Then they choose amortization terms that flatter their income. Early on, earnings look robust. Wall Street applauds. But the clock is ticking, and when the amortization wave finally hits, the illusion fades. One of the most notorious examples, the telecom boom. Companies acquired spectrum licenses and amortized them slowly, making early profits shine. When competition intensified and revenue lagged, the delayed expense exposure crushed them. Investors realized too late. They'd been watching the wrong time. Here's your clue. Compare depreciation and amortization schedules to industry peers. Are they unusually long? Do they conveniently align with executive bonus periods? Look for sudden changes. A revised asset life in footnote 17 could be the signal that earnings are being massaged, not built. Because in this trick, the magician isn't showing you false numbers. He's showing you stretched ones, bent timelines, distorted reflections. And while the clock ticks normally in the real world, inside the income statement, time bends to management's will. And just as time can be warped, value too can be disguised, especially when it comes to inventory. In the next act, we'll watch how the magician uses inventory accounting to turn cost into illusion and illusion into profit. Chapter 9. The Inventory Illusion, Turning Cost into Profit. Now the magician moves to his next act. A stack of boxes behind him, labeled inventory. He smiles and says, "These goods haven't moved, but watch closely. They're about to make us rich." And with that, He performs the oldest accounting illusion in the book, turning inventory into earnings. Inventory isn't just stuff in a warehouse. It's an accounting sandbox, a place where timing, valuation, and cost flows create the perfect environment for manipulation. Depending on how you count it, inventory can inflate profits, lower taxes, or hide operational rot, and most investors never notice. There are two key accounting methods at the heart of this trick: FIFO and LIFO. FIFO, first in, first out, assumes the oldest inventory is sold first. In an inflationary world, this results in lower cost of goods sold and higher profit margins. LIFO, last in, first out, does the opposite, showing higher COGS and lower profits, but reducing taxable income. The choice between them isn't about reality, it's about presentation, and that's where the illusion lives. But the real show begins with inventory write-downs, or rather, the absence of them. A company sitting on obsolete or unsellable goods can avoid reality by keeping inventory at inflated values. As long as they don't write it down, it quietly props up the balance sheet, creating a false sense of strength. Eventually, the reckoning comes, usually in a one-time charge. But by then, the illusion has served its purpose, buying time, avoiding scrutiny, and hitting earnings targets. Take the example of Krispy Kreme during its early 2000s expansion. The company booked high inventory values tied to its aggressive store rollout. When the donuts didn't sell and the expansion faltered, write-downs followed, but only after investors had paid for the growth illusion. Want to know if you're being tricked? Examine inventory turnover ratios. Are they slowing? Compare growth in inventory to sales. Are goods piling up faster than they're being sold? Check footnotes for changes in valuation assumptions or sudden shifts in cost flow methods. These subtle cues can reveal that what looks like a strong gross margin is just a mirage built on stale dough. Inventory should represent opportunity, future sales, not forgotten mistakes. But in the wrong hands, it becomes camouflage, a way to dress up a struggling business as a thriving one. And just like the magician's silk scarf, it looks colorful until you realize it's hiding something underneath. But if inventory is about disguising the present, the next trick is even more dangerous. It's about reshaping the future itself. The magician now invites us to peek into forecasts and promises, where illusion and ambition blur beyond recognition. Chapter 10. The Crystal Ball, Con, Forecasting Illusions. The magician now dims the lights. "Let me show you the future," he whispers. And up on the screen, a dazzling chart appears, revenue climbing, margins expanding, profits soaring. The crowd gasps. The company hasn't done it yet, but it will, they're told. Welcome to the Crystal Ball Con, a performance built not on numbers, but on narrative. Forecasts are not lies. They're dreams wrapped in spreadsheets, and when wielded by skilled illusionists, they can reshape investor expectations faster than any earnings report. CEOs talk of hockey stick growth, CFOs project improving margins, and analysts, desperate to believe, plug it all into their models. But here's the trick: assumptions. Forecasts are castles made of ifs. If the market grows, if costs shrink, if new products launch on time, if inflation stays tame. Each line item in a forecast hides a potential crack. But presented confidently, with the right tone, these projections become destiny in the eyes of the market. Take WeWork in 2019. Their investor deck painted a picture of a global empire, 10x growth, 30% margins, infinite demand. SoftBank bought the illusion. The media echoed it. But what was buried inside? Assumptions that occupancy rates would remain near perfect, that rent spreads would rise, that competition wouldn't undercut them. When reality returned, the IPO collapsed, the magician fled, and the audience, left stunned by a future that never arrived. The danger isn't just in being wrong, it's in believing that projections are neutral. They're not. They're a weapon, used to justify valuation, raise capital, and delay accountability. And they're almost always optimistic by design. So, how do you see through it? Don't just look at the chart. Ask, what are the levers behind this growth? Are customer acquisition costs dropping, or just assumed to? Are economies of scale proven, or projected? Look at historical accuracy. Has this company ever met its own guidance? If not, why believe them now? Great forecasts are built on conservatism and clarity. Illusions are built on confidence and hope. Know the difference, and you'll never mistake storytelling for strategy again. And yet, while some illusions look forward, others are buried deep in the past, hidden behind the curtain of one of the most trusted institutions in finance, the auditor. What happens when even the watchdog wears a mask? Chapter 11. The Watchdog in Disguise, Auditors and the Trust Illusion. The magician now introduces a companion to the stage, someone dressed in a suit, clipboard in hand, eyes scanning the script. "Don't worry," the magician says. "This is the watchdog, the guardian of truth." And the audience relaxes, believing they're safe. But what if the watchdog isn't barking, because it's part of the act? Welcome to the trust illusion, where the very people meant to verify the numbers are often too close to the ones who created them. Auditors are seen as impartial, professional, and incorruptible. But the truth? Auditing is a business, and the client is the one writing the checks. Think of Arthur Andersen, once among the most respected firms on Wall Street. Their collapse in the wake of the Enron scandal wasn't due to a missed decimal. It was due to systemic complicity. They didn't just fail to spot the fraud. They helped craft the illusions, signing off on off-balance sheet arrangements and mark-to-model valuations that defied common sense. And they're not alone. In the decades since, auditors have been tangled in scandals across the globe. Wirecard, Luckin Coffee, Carillion. Each time, investors ask, how could they miss it? But that's the wrong question. The better one is, what incentives did they have to look away? Auditors operate under pressure. Pressure to retain clients, to avoid conflict, to approve just enough to be credible, but not so much that the client walks. Many offer lucrative consulting services on the side. The relationship becomes cozy. Independence blurs. And while regulations like Sarbanes-Oxley tried to tighten the rules, the illusion persists. A clean audit opinion still feels like a stamp of truth, when really it's a statement of reasonableness under the client's own assumptions. So, what can you, the skeptical investor, do? Read beyond the audit opinion. Go into the critical audit matters section. Look for disagreements, for soft language like, management believes. We noted no material exceptions, based on representations. These aren't confirmations, they're caveats. Real truth seekers know that an audit is a layer, not a seal, that numbers can be signed off and still be misleading. That trust in institutions must be earned, not assumed. Because when even the watchdog is playing along, the magic show becomes more than a performance. It becomes a trap. Next, we'll examine how illusions aren't just crafted quarterly. They're baked into compensation plans, turning executives into illusionists incentivized to deceive. Chapter 12. The Bonus Mirage, when pay fuels the performance act. Now the magician reveals his true motive, not applause, not fame, but something far more potent, incentives. Because behind every illusion, there's a reward. And in the world of corporate finance, that reward is often tethered to performance-based compensation. Bonuses, stock options, restricted shares, and EPS-driven pay packages. This is the bonus mirage, and it's where magic becomes manipulation. Picture this. A CEO's annual bonus is triggered when earnings per share grow by 15%. But growth has stalled. What to do? Pull forward revenue, delay expenses, restructure again, stretch depreciation, all technically legal. All designed to manufacture the number that unlocks the vault. It's not just performance, it's performance art. The most dangerous illusions in finance aren't built to fool investors. They're built to hit targets. And those targets are often blunt, simplistic, and gameable. If net income matters, then costs are buried. If revenue matters, then discounts balloon. If free cash flow matters, then capex is slashed, even if it hurts long-term growth. The metric becomes the mission, and truth becomes optional. Consider the 2012 scandal at Hewlett-Packard after it acquired autonomy. The deal was driven by lofty growth projections and synergies that never existed. Autonomy was accused of inflating revenue through aggressive accounting just before the sale. Why? Because the founders and executives had massive payouts tied to performance milestones. The Mirage was worth billions until it wasn't. Or look at Valent Pharmaceuticals, where management tied bonuses to ever-growing EBITDA, pushing them to make rapid-fire acquisitions and hike drug prices. The house of cards eventually collapsed, leaving reputations scorched and investors stunned. As a smart investor, you must ask, what's being rewarded? Read the proxy statement. Identify which metrics drive compensation. Are they long-term focused? Are they tied to stock price or real performance? Is there clawback language for manipulation? If a magician gets paid more for the illusion than the truth, guess what he'll show you? You can't blame executives for responding to incentives. That's human nature. But you can decode those incentives and anticipate how they'll bend reality to reach their goal. Because in this act, the magic doesn't happen on stage. It happens in boardrooms, written in clauses, and signed in golden ink. And in our next insight, we go deeper, past executive rewards and into the guts of valuation, where ratios can deceive just as easily as numbers. Chapter 13. The Ratio Distortion, Numbers that Sing but Don't Speak. The magician now holds up a chart, sleek, simple. Debt to equity is low. He smiles. Current ratio is solid. ROE is rising. And the audience breathes a sigh of relief. The numbers seem to speak for themselves. But in truth, they don't speak at all. They sing, a tune carefully composed to soothe, to distract, to seduce. Welcome to the art of ratio distortion. Ratios are the darlings of financial analysis. They compress complexity into simplicity, one number to rule them all. But therein lies the trick. Ratios amplify manipulation. Once the magician tweaks the numerator or denominator, even slightly, the whole meaning changes. And most never notice. Let's take return on equity, ROE, seemingly a measure of efficiency. But what boosts ROE? Higher net income or lower equity. So, what do companies do? They engage in share buybacks, reducing equity and inflating ROE without creating any real value. It's a financial facelift, not a performance gain. Or consider current ratio, current assets divided by current liabilities. Looks healthy? Not if those assets are stale inventory or slow-paying receivables. The number might be 2.0, but if it's built on sand, it means nothing. You're just staring at a painted-on smile. Debt to equity is another favorite. But what if leases are off the balance sheet? What if goodwill inflates equity? What if preferred stock sits silently under the equity line? The ratio whispers reassurance, while reality screams risk. This is how companies dazzle. They engineer the inputs, not the outputs. Capitalizing costs to inflate assets, delaying expenses to boost earnings, spinning off debt-heavy units to lighten their balance sheet. Then they present the ratios, clean, crisp, and utterly misleading. One infamous case, General Electric in the early 2000s, GE presented stunningly stable financial ratios. But behind the curtain, GE Capital had become a labyrinth of opaque transactions, deferred liabilities, and off-book exposures. The ratios hid the rot, until they couldn't. So, how do you see through the distortion? Deconstruct the ratio, understand what drives it, check definitions, compare across peers. Read footnotes, companies often adjust or redefine metrics to suit their narrative. If a ratio looks too good to be true, it probably is, especially when all the marketing slides are built around it. Because when a magician sings, you may not hear the lie. You feel the performance. But you're not here to feel. You're here to know. And next, we uncover perhaps the most dangerous illusion of all, when the numbers don't just mislead, but actively predict a future that will never come. A future crafted by valuation models that promise wealth and deliver disaster. Chapter 14. The Valuation Mirage, Castles Built in the Sky. The magician now holds out a crystal tower, a valuation so pristine, so mathematically elegant, that it feels irrefutable. Based on our discounted cash flow model, he proclaims, this company is worth $42 billion. The audience nods, seduced by the precision. But what they don't realize is this. The entire tower floats on air. Welcome to the Valuation Mirage, where spreadsheets become fairy tales. Valuation models, DCF, comparables, multiples, promise objectivity. Numbers go in, numbers come out. But the illusion lies in what you feed the machine, because a DCF isn't a truth machine, it's a story engine. And the wrong inputs, dressed up in formulas, produce outputs that feel scientific, even when they're pure speculation. Picture this. You forecast revenue to grow at 25% per year for a decade. You assume operating margins will double. You assign a terminal growth rate just shy of GDP. You discount at 8% to feel conservative. The output? $1 billion valuation. It all seems so clean until you change a single variable and the whole structure collapses. This is how companies, bankers, and promoters sell dreams. They don't have to lie. They just choose rosy inputs. They project strong growth. They use industry standard margins. They benchmark against market leaders, not peers. And just like that, they conjure value from thin air. Take Theranos. The private biotech unicorn promised revolutionary blood testing. Investors valued it at $9 billion on projections, promises, and carefully constructed decks. But there were no revenues, no viable product, just a valuation model built on delusion. The story was so good, even veterans fell for it, until it fell apart. Even in public markets, this mirage persists. Investment banks often publish valuations that justify mergers, IPOs, or strategic decisions. But buried in the footnotes, disclaimers, assumptions, sensitivity analyses that show how fragile the model truly is. As an investor, your defense isn't to avoid models, it's to break them. Stress test every assumption. What happens if growth slows? If margins shrink? If the discount rate rises? Build in your own margin of safety, not with formulas, but with skepticism. Because valuation isn't the destination, it's the map. And if the map is drawn by someone with an agenda, you'll end up in a desert, chasing a mirage that never becomes water. In the next insight, we'll journey into the darkest corners of the magic show, where even credit ratings, the supposed guardians of financial sanity, become part of the illusion. Chapter 15. The Credit Rating Costume, When Risk Wears a Mask. The magician now takes center stage with a letter, an A, perhaps a BB, stitched in gold across his chest. See this, he says, we're investment grade. And the crowd breathes easier. Pension funds nod, risk managers relax. But behind that golden letter lies one of the most elegant deceptions in finance, the credit rating costume. Credit ratings are supposed to be warnings, signals of risk issued by agencies entrusted with keeping investors informed. But over the years, these letters have become costumes, outfits stitched together by flawed models, conflicts of interest, and a dangerous desire to please. In 2008, the world watched as AAA-rated mortgage-backed securities collapsed like papier-mâché in a monsoon. Moody's, S&P, Fitch, they'd all stamped their approval. Why? Because the issuers, the very banks selling the debt, were the ones paying the rating agencies. The system was upside down. The watchdog got paid to nod. And when the financial crisis hit, trillions in supposedly safe assets were suddenly radioactive. Municipalities, insurers, pension funds, they all held what they thought was stability, only to discover they'd bought into illusion. But the costume didn't vanish after 2008. Today, companies still parade into markets with investment-grade badges that may not reflect their true risk. Why? Because rating agencies, seeking relevance and revenue, often grade on a curve. They rely on management's projections, not just past performance. They use models that underestimate volatility. And they know downgrades can trigger panic, so they tread lightly. General Electric, once the bluest of blue chips, maintained its high rating for far too long, despite ballooning debt, shrinking cash flows, and accounting concerns. When the downgrades finally came, investors had already suffered. So, how do you see through the costume? Don't just glance at the rating, read the outlook, watch for changes in tone. Compare bond yields to ratings. If a BBB bond trades like a junk bond, the market may already see the truth. Review debt covenants and interest coverage. A good rating with bad fundamentals is like a velvet curtain hiding a broken stage. Remember, credit ratings aren't guarantees. They're opinions, delivered by institutions with imperfect insight and conflicted incentives. You're not here to accept them. You're here to investigate. Because when the magician walks out in costume, it's not to show you who he is. It's to hide what he's become. Next, we'll step into a different kind of illusion. One built not on numbers, but on the narrative of mergers and acquisitions, where synergy is promised, but sorcery often delivered. Chapter 16. The Synergy Spell, when M&A turns into make-believe. The magician now brings two companies onto the stage. Watch closely, he says, as we combine these two and create magic. A puff of smoke, a swirl of buzzwords, synergy, cost savings, revenue acceleration, and suddenly, a mega-corporation is born. The audience erupts in applause, but the illusion has only begun. Because beneath the confetti and investor decks lies one of the oldest tricks in corporate theater. the synergy spell. Mergers and acquisitions promise growth, dominance, and efficiency, but more often they deliver confusion, culture clashes, and value destruction. Yet time and again, companies chant the same spell. We'll save $300 million a year. We'll expand our market. We'll unlock shareholder value. But if synergy is so magical, why do so many mergers fail? Here's the truth. Synergy is intangible, and that makes it the perfect disguise. Companies can bake it into earnings forecasts, justify overpaying, and delay reality under the guise of integration periods. And investors, desperate for upside, fall for it. Think of AOL Time Warner, a merger that was supposed to define the digital future. Instead, it wiped out over $200 billion in shareholder value. Or HP's acquisition of Autonomy, sold as a strategic breakthrough, but it ended in fraud allegations and an $8.8 billion write-down. What happened? Illusions, aggressive assumptions, cultural misalignment, and a failure to see that combining two flawed businesses doesn't create a strong one. It just compounds the weakness. Behind every transformative deal, there's a spreadsheet. And in that spreadsheet, there's a forecast. And inside that forecast is belief, not fact. Belief that layoffs will go smoothly, that tech platforms will integrate perfectly, that customers won't flee. But history tells a darker tale where promised synergies become expensive write-offs. So, how do you spot the illusion before it consumes value? Look for the structure. Was the deal paid in stock or cash? Stock deals often suggest overvaluation. Was goodwill created? How much? What's the timeline for synergies, and are there metrics to track them? Is management incentivized by the deal's completion or its results? And watch the language. If you hear transformational, bolt-on, or platform expansion without clear math or milestones, it's likely a spell, not a strategy. Because real value comes not from merging two companies, but from merging vision with discipline. And when that's missing, the only thing that multiplies is illusion. Next, we'll shift from corporate spectacle to personal psychology. How investors themselves become part of the show, hypnotized by narratives and blind to the numbers that matter most. Chapter 17. The Investor's Trance, When Narrative Blinds Analysis. The magician smiles, but this time, he doesn't speak. He lets the audience imagine. He lets the story do the work. This company is changing the world. This founder is a visionary. This industry is the future. And just like that, the spell takes hold, not in the numbers, but in the minds of investors. Welcome to the Investor's Trance, where logic fades and narrative rules. This is the most powerful illusion of all, not cast by CEOs or CFOs, but by our own desire to believe. We don't invest in spreadsheets. We invest in hope, in momentum, in the excitement of being early, of being right. That's why a pre-revenue AI startup can raise billions. That's why a meme stock can surge 500% on a Reddit thread. The numbers didn't change. The story did. We're pattern-seeking, meaning-making creatures. And markets, though filled with professionals, are just large theaters of emotion. When a charismatic founder speaks with conviction, when a deck says 10x market opportunity, we want it to be true. And in that wanting, we suspend skepticism. We stop asking, where is the cash? What are the margins? How sustainable is this? Take Nikola, the electric truck company that once promised a hydrogen-powered future. Videos showed trucks rolling down highways, later revealed to be coasting downhill. Yet the market cap soared past $30 billion. Why? Because the story felt right. It was green. It was bold. It was next. And the numbers? Buried beneath the applause. But the trance isn't limited to frauds. Even legitimate companies create emotional gravity. Tesla, Nvidia, Apple. They inspire confidence, loyalty, and yes, sometimes blindness. That's not to say they're bad investments, but it's to remind you, emotion is a data point, not a strategy. So, how do you break the trance? Ask yourself, would I still love this company if I didn't know the CEO's name? If I never saw the stock price? If all I had were the financials, what story would they tell? Challenge your own beliefs. Track sentiment. Notice when excitement outpaces earnings. Because when you awaken from the narrative, you gain a superpower. You begin to see the show, not just as entertainment, but as evidence. And you stop being the audience and start becoming the analyst. Next, we'll examine a darker corner of the illusion, pension assumptions. where future promises are hidden behind optimistic math and buried in footnotes that few ever read. Chapter 18. The Pension Promise, Hiding Risk in Tomorrow's Math. Now the magician steps into shadow. This, he says softly, is our obligation to the future. He gestures to a quiet line on the balance sheet, pension liabilities. And then, with a subtle sleight of hand, he transforms a towering long-term burden into a tidy little number. The audience sees stability, security, but what they don't see is the math behind the curtain. Welcome to the Pension Promise, where risk hides in assumptions and comfort is carved from illusion. Defined benefit pension plans aren't dead. They've just become invisible. Today, many companies still carry massive obligations to retirees, future payments stretching decades ahead. But because those obligations are grounded in assumptions, discount rates, expected returns, mortality estimates, they become clay in the hands of the illusionist. The trick is elegant. If you assume a higher rate of return on pension assets, the liability shrinks. If you assume people die younger, the future payout drops. If you smooth gains over longer periods, volatility disappears. And suddenly, a heavily underfunded pension plan looks manageable, even profitable. The company books income today, based on projections about tomorrow, a mirage wrapped in math. Take General Motors, once celebrated for its pension plan returns. In reality, it had baked in aggressive return assumptions that masked the true cost of its retiree promises. When the 2008 crash hit and returns collapsed, the obligations overwhelmed the company. The pension illusion shattered, and taxpayers picked up the pieces. Or look at Delta Airlines, which in the early 2000s used optimistic return assumptions to boost reported earnings. When markets dipped and plans fell short, the company was forced to freeze its pension and seek bankruptcy protection. The key question isn't just, how much is the pension liability? It's, how is it calculated? Look at the discount rate. Too high? Question it. Review the assumed return on plan assets. If it's 7 to 8% in a 3% bond world, be suspicious. Dig into footnotes for funding status, contribution plans, and sensitivity tables. The numbers are all there, but the truth is often between them. Because pensions aren't just financial obligations, they're promises. And when a magician turns promises into profit, it's not magic, it's misdirection. Next, we'll pull back from individual tricks and look at how to build your own financial lie detector. A mindset that sees the illusion coming before the curtain even rises. Chapter 19. The Financial Lie Detector, Training Your X-ray Vision. The magician bows. The stage is littered with illusions, floating profits, masked losses, forecasted fantasies. But now the lights turn toward you, because the next act isn't his, it's yours. It's time to become the financial lie detector, the one person in the room who sees through the velvet, past the lights, beyond the trick. You don't need to memorize every accounting trick. What you need is a lens, a mindset, a way of reading financial statements that's less about what's shown and more about what's omitted. Think of it as X-ray vision. You're not scanning for beauty. You're scanning for bone fractures beneath the surface. Start with this rule. Ask why twice as often as you ask what. If revenue is rising, ask why. If margins spike, ask why. If debt looks steady, but cash is low, ask why. Each why is a thread. Pull it long enough, and the costume unravels. Build your toolkit. Cash flow statements, income statements, footnotes, headlines, trends, one-off surprises. Learn to cross-reference. Does EBITDA growth align with free cash flow? Is goodwill ballooning without clear justification? Is depreciation falling while CapEx surges? Trust, but verify. When a company boasts of non-GAAP earnings, adjusted metrics, or normalizing factors, don't dismiss them, interrogate them. Why were those adjustments made? Do they repeat every year? Are they designed to clarify or to conceal? But your real edge isn't technical, it's emotional. The greatest lie detector in finance is emotional neutrality. Don't fall in love with the brand. Don't chase hype. Don't follow the herd. Step outside the narrative, strip away the charm, and look at the cold, boring math. Because in those numbers, those gray, lifeless tables, you'll find the pulse of the business, or its lack. Every great investor has this gift. Buffett reads footnotes like detective novels. Howard Marks reads credit risk like weather maps. They don't predict the future. They eliminate illusion. And in doing so, they see clearer, act wiser, and profit when others clap for ghosts. The financial lie detector isn't a tool, it's a transformation. A mindset that replaces excitement with inquiry, surface with substance, illusion with insight. And now that you've seen the show from behind the curtain, we reach our final act. How to weaponize this clarity to spot real opportunity and avoid becoming just another name in the audience. Chapter 20. The final act, seeing opportunity, where others see. Shows. The curtain has fallen. The illusions are spent. The magician has taken his bow and exited the stage. But you're still standing. Because now you see what others don't. You're not dazzled by projections. You're not hypnotized by narratives. You're armed. This is the final act, not of deception, but of discernment. And it begins with seeing opportunity not in the sparkle, but in the silence. Here's the paradox of truth. When you strip away the illusions, what remains often looks dull, unremarkable, even boring. But that's exactly where long-term value lives. Great investments rarely shout, they whisper. The companies that don't dazzle headlines, but quietly compound value year after year, those are the ones worth finding. Take Berkshire Hathaway. For decades, no flashy quarterly guidance, no earnings acrobatics, just boring reports, plain language, and discipline. Or Costco, a business that thrives by saying no to most retail gimmicks, focusing on margins, membership, and consistency. To many, these firms seemed unexciting, but beneath that plainness lay truth, and truth compounds. Now you know how to find it. Scan for companies where cash flow exceeds net income, where goodwill doesn't inflate like a balloon, where management speaks plainly and delivers steadily, where the ratios make sense because they're built on substance, not spin. Look for red flags, yes, but also look for clear glass. Financials so clean, they feel boring. That's often where the real gold lies. And as others run from write-downs, fear footnotes, and flee from complexity, you'll lean in. Not because you enjoy the mess, but because you now understand the method behind it. Where others see chaos, you see clarity. Where others see decline, you ask, is this temporary? Is this misunderstood? Is this a show or a signal? Because truth in finance isn't found in flash. It's found in patterns, in discipline, in the gap between what's said and what's filed with the SEC. You've spent this journey learning how illusions are crafted, but the real prize isn't detection, it's decision. To walk away from the noise, to build positions in the shadows, to trust the numbers after you've burned through the deception, and to become not just an analyst, but an investor who cannot be fooled. And now, all that remains is for you to step onto your own stage. Call to action. Become the skeptic who never gets fooled again. You've seen the tricks, you've followed the illusions, you've watched the curtain rise, and now you know what lies behind it. While others are still clapping at the magic, you've become something different, not cynical, not jaded, but clear-eyed. You've learned to question, to decode, to listen between the lines of earnings calls and footnotes. That's no small transformation. It's a superpower. But this knowledge only matters if you use it. So here's what to do next. Pick a company, any company, open its latest 10K. Look not at the headlines, but at the details. Trace the goodwill, track the depreciation, question the pension assumptions. Ask yourself not what the company wants you to see, but what it hopes you'll ignore. That's where insight lives, and that's how edge is earned. If this journey made you feel something, powerful, skeptical, free, then you're not alone. Join the growing community of investors who refuse to be hypnotized by glossy charts and smooth-talking CEOs. Share this video, subscribe, leave a comment telling us which illusion fooled you once, and how you'll never let it happen again. Because in the world of investing, it's not enough to be smart. You must be awake, wide awake. And if you remember just one thing, let it be this. Magic only works on those who want to believe. You've chosen to understand